Tribe of Noise Music. 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 Tribe of Noise Music.
We are getting everybody together. I've had a travel play, so I'm going to be mobile while doing this. It should work fine, but that means that you've been capable hands of Trent, and hopefully Misha as well once he gets here.
Hey, how's everyone doing today? All right. Filling out pretty nicely.
Yeah, let's give it another minute or two. So as you're joining, please feel free to tweet it out, get people in. It's going to be a fun conversation, probably about an hour. we're going to talk about how the stock market's broken. Now we might just fix it. And I will enjoy the skyline of Manhattan from New Jersey until I come into Manhattan.
As a reminder for everybody, if you have questions, it would be helpful if you threw them into the Discord, the Permuto Capital Discord, just as everything is happening. Gene, you want to accept Rabam?
I believe I tried. So try it again. Yeah, he's got a co-host invite. Hopefully, he can figure out how to do that.
Well, it says request in the bottom right. Hold on.
Yeah, I know. I gave him a yes. I think.
Yeah.
Let me cancel and try it again.
I'm not the lead.
Hopefully, he can figure it out on his end.
It is what it is.
Well, while he and I do that in the background, let's sort of get going here. So this morning, we published a blog post that talks about a potentially very serious problem that's been festering and growing worse in how the macro capital markets work. And so, Trent, give everybody a genesis of where this sort of thought came from, and then I'll start walking you through the various points of it.
Right. Yeah. So look, I think this is, whenever you run in Wall Street circles, especially in New York, right? Everybody asks, what's the next catalyst going to be that's going to hurt the markets or help the markets? It's a very popular bar or pub conversation. For a long time now, it has been my view that I didn't think that capital markets were working properly, and it's actually a pretty sobering thought. A lot of people will say that capital markets are not, they're rigged. It's a rigged game. The stock market's a rigged game, etc. Honest to God, until I wrote this blog, until I actually acquired all of the data, I don't think I believed it was rigged. What I will say is I don't think it's fair either. And I think we're somewhere in between right now. And we're kind of at a pivotal tipping point to say, are we going to be a world that is dominated by what was large will always be large, and fundamentals and what the next thing is and the next growth company is does not matter anymore? Are we ready for that? Or are we ready to say that, hey, maybe active management did matter a little bit? There's long been a back and forth in the industry of it's, whether or not, well, it could be boiled down to Malkiel versus Graham, right? There are efficient markets and everyone should buy indexes, and there are value investors who should buy what is valuable and what people can perceive as having value into the future based on their own individual characteristics. Both sides have virtue. They both have value to them. But if either side gets out of whack with the other, it creates unintended consequences. And that's really what we talk about in this blog. And there's a lot of data. We can go into all of the data. We can go into why we thought each of the pieces of data mattered. But that's really the thought process, is that capital markets currently are not functioning properly. A IPO should not be up almost 400% in the span of 8 days. That is not efficient markets. It's also not efficient markets for people to tell you, hey, we need at least an 100% pop in order for us to take your company out. You need to value yourself 50% less in order for us to care. That's not efficient. That's not proper. That doesn't make sense. And it's never going to, and for the last 4 years, really, 3 years, I guess, no one's really gone public. And I'm starting to see the reason for that. It's because no one was willing to take that discount. So I'm glad to be able to share this conversation. Yeah, go ahead. Go ahead, Gene. I can now hear you.
Oh, yeah, sorry. I can now hear you. Yeah, sorry, my bad. What I was going to say was, let's talk about the macro problem first. You're kind of talking about the micro problem. What's it look like? How does it work? And, what drives your confidence that it's a real problem?
So on a macro standpoint, if you look at the returns of the market, generally speaking, the returns of the market are supposed to be more or less normal, and with a little bit of wide tails statistically, right? If we're statistically speaking, that's how the market is supposed to work. If you ran the mean on the S&P 500 over from 1990 to 2007, and then from 2008 on to today, you would see that the mean grew about 10%. That's not that bad. That just means that you're moving the center of that normal distribution to the right. That's okay. The problem is, over the same periods of time, we saw a 28% increase in standard deviation. That means we are becoming more skewed. What does that actually mean to you, people in the market? That means we are becoming more volatile, and not in a good way. A lot of people like volatility because they say it means we have more times for the up and we have more times for the down. That's not what we're seeing. We're seeing more rapid and violent increases and decreases. And I only showed the data for intraday. I did not even show when the market was up 2% and then fell to down 1%. That would be down 1% in my data, not down 3%, even though there was a move of 3% on that day. So if we take that world, the market is becoming more and more volatile. The amount of 3% or 5% or 7% moves that are occurring is increasing, not decreasing. The size of companies has increased to the point where if the S&P 500 moved from 2008 till today 3%, it's about 1.1 or 1.2 trillion on average. From 1990 to 2007, the average value of the S&P 500 was about 8 trillion. So we're talking about a 15% move. Macro-wise, we're losing sight of how large these companies are and how large of moves these actually are on an underlying basis. And it's very scary when that happens, because a $1.2 trillion move, if the S&P 500 moves up 3%, we just created 1.2 trillion in wealth. So when we're looking around and saying, oh, well, we have an issue with inflation, well, maybe our issue stems from this issue, which is that when money flows into ETFs, it gets magnified by these momentum funds, and then it gets magnified further from fundamental funds that have to react to those changes. And all of a sudden, a seemingly innocuous 50 basis point move due to fund flows into ETFs becomes a 3.5% move. That's very dangerous for the market, as we have shown in the blog.
So tell me a little bit more about, why you and I have talked about this as potentially a free rider problem from kind of the index investing point of view.
Yeah, so Malkiel famously said that a monkey could outperform, I'm paraphrasing, a monkey could outperform an active investor. In today's day and age, I think a lot of people have probably been told experts can't beat the market, so you shouldn't try. And we've said that for so many years, really since 1973. And now pretty much everybody involved in the market believes it. We've got hedge funds trading patterns, whether it be momentum or mean reversion or any number of different strategies that are very well documented. Or we have passive index funds that own 21-22% of the entire market and all of the stocks there, 11 trillion. And you've got this scenario where since 2012, according to the Fed, active mutual funds owned 34% of stocks outstanding. Today, they own about 13%. They've fallen 21% at the same time that ETFs have gone from approximately 0% to about 21%, or $11 trillion. And it's accelerating. In the last 2 months, there's been about $60 billion of inflows, I think it's like $68 billion of inflows and about $60 billion worth of outflows, from $60 billion of inflows into ETFs or / passive funds, and about $60 billion worth of outflows from active managers. You've got a $120 billion swing in the span of 2 months from active to passive. Now, the free rider problem that Gene is talking about is that active investors set prices, passive investors don't. So if you or I said, well, we can't beat the market, I'm just going to buy the S&P 500 in this exact weighting, well, that's okay. You can do that. Problem is you're not making a decision on valuation. What you're doing is you're actually relying on someone else. You're relying on that market to be efficient. And the problem is the more that we take money out of active funds, the more we take money out of RIAs, out of intelligent money, the more we take money out of fundamental investors. And we put them into passive investors or technical analysis or anything like that. We have actually destroyed the concept that good companies will trade well and bad companies will trade poorly. And that is the crux of this free rider problem, which is that you are a regular index passive ETF holder is not making a decision on the valuation of any one of those 500 companies they're investing in. They're just saying, I want to own the market. And that is very dangerous for micro and macro market structure.
So 2 weeks ago and a few hours ago, we were in front of the SEC Crypto Task Force, and we introduced this concept to them. How would you relay their interest and thoughts?
Well, look, I don't pretend to speak for the SEC, but I can say I started out this space as saying that what I experienced when writing this and when pulling together the data was sobering. I believe it was a sobering fact to everybody involved, whether that be the SEC, whether that be Skadden, who was on the call with us, or whether that be any of us that were at the table in person. I don't think anybody loved to hear that the market that holds $55 trillion worth of wealth in America and abroad is more or less faltering and not efficient. I don't think anybody wanted to hear that. And I think it was sobering for all involved. And I think everybody wants to look for a solution. I think it's very beneficial that we brought this up when we did, because I don't think we're at a point of no return. I think we can get back to a point where active investing is valuable again, but we're not far off of it. And so
this is
I think everybody at the table realized that, whether it be Skadden, us, the SEC, or anybody else. I believe that everybody believed at that table this is a problem that we are going to be faced with, whether it not be today, but in a couple of years. We can't turn away from it. I think that's probably the takeaway.
And I think this is a great time to kind of put the umbrella away, let the clouds part, and talk about the sunshine of, so how does the Permuto AC/DC concept really give tools back to active investors to solve this problem?
So if we take a stock that's been fairly range bound over the last 5 years, let's say it's up about 3%. I'm giving you a real example. I'm just not giving you the stock that it is. It's up about 3%. And if you would have dividend reinvested that stock, it would be up 21% over the last 5 years. That would be an underperformance of about 72%. The market over the same period returned about 93%. If you would have said, hey, look, this company is trading at a pretty high PE, but it's growing a little above GDP. So it's growing about 3.5%, 4.5%. I have a good belief that the operations of this company are solid and they're not going anywhere. What you could have done at that point in time is just bought the dividend certificate. In doing so, you're making a bet that that company is going to increase their dividends over time. That's a bit of a proxy for their operational cash flows. So let's say that you would have 5 years ago said, I want to put my money into the DC. Well, on estimate, you would have been up about 96%. You would have outperformed by 3% a stock that was range bound. It massively underperformed the S&P 500 over the past 5 years. If you would have felt really good about your decision, which you said, I really want to be long the operations of this company, but I really don't believe that the stock is going to move up in the same amount that dividend is going to, right? Meaning, in other words, their valuation multiple on their operations is maybe a little too high currently. What you could have done is you could have longed the DC and you could have shorted the AC. What that would have given you at the end of 5 years, including the drag on the short leverage, could have been somewhere around 106%. You could have outperformed over a 5-year period by about 13%. What that allows you to do, you just took a range-bound stock. You could have either outperformed via that stock by 3%, the general market, or you could have outperformed by about 13%. That's extraordinarily powerful. That gives you, the investor, the ability for a company. You don't have to predict what that company is going to do stock price wise. You have to predict what you believe about the operations of the company. It takes you back in time to a world where you were a buy and hold investor. You buy and hold what you know, right? If you like to drink Coca-Cola, you can go out and buy Coca-Cola, and that can be an investment regardless of the fact that the company trades up 2%. You as an investor can actually outperform the broad-based S&P 500. That's very powerful inside of that individual stock. So you can choose instead of saying, oh, if I want to buy Microsoft today, I have to buy 84% of an AC and 16% of a DC, which is approximately what the stock valuation comes to. You don't have to say that anymore. You can say, I just want the dividend, or I just want the asset, or I want the dividend, but I want to sell the asset. It gives you a lot of optionality as an investor, optionality that hedge funds may have had in the past, but retail investors, people like you and I, RIAs, have never had before. Gene, you still there?
Sorry, wrong button. I said, so, we're still in this world where for a lot of investors, this is a lot of work and a lot of a new set of analysis. Do you think, and can you tell us a little bit more about what sort of products this can breed that will give kind of more leveraged ability for average investors to, in some ways, be a part of the solution and not a problem, but still, do something that looks like ETF index investing?
Yeah, look, so a lot of us here, right, probably wish their money could provide them, 3, 4, 5, 6% returns into the future, and be very comfortable in that fact. There's obviously, when these come out, when our ACs and DCs come out for a single stock, we're going to be looking into things like securitizations, things like ETFs, to help people wrap their minds around it. The thing is, all of those are possible, and all of those are even likely that the average person that's listening to this will likely say, I don't want just Microsoft. I want Microsoft, Apple, and Broadcom put together. I want all of those dividends, and I want to buy it all at once. It's pretty logical. That's a logical way of thinking about it. The great part about how, even if you do that, even if you're buying an ETF based on these products, you're not contributing to the problem, is that people, active investors, cannot take advantage of mispricings in a market because they have to buy at the exact ratio of asset and dividend currently that the market trades at. What we're allowing those other market participants to do, call it the RIAs, right? If you don't want to think about this, you can go to your nearest RIA, and they should be able to walk you through how this contributes to your retirement or how this contributes to your upcoming plans. They should be able to do that. Your RIA becomes your active investor, your portfolio creator, your portfolio manager. They have a lot of meaning. You can go and buy the ETF, but that doesn't actually hurt the market. What it does is it creates demand for one side of the market. Let's say you as an investor want to purchase the dividend component and just the dividend component. And let's say that dividend component becomes extraordinarily valuable. Then the active manager can go to the appreciation component or the asset component and purchase that for their clients and experience great returns there. because they believe that the stock will increase from where it currently is. So it reinforces the valuations that exist in the market today, rather than you having to take a view on the valuation of the underlying company, right? So if you say, I'm very willing to invest in Microsoft at a 5% dividend yield, you can make that choice, and the ETF can make that choice for you. But what it does is it actually forces a decision on the other side. Does the asset certificate believe that that portion of the stock is worth that little at that point in time? Or do they believe that there is a lot of room for growth there? So you're not a part of the issue, but you're a part of now a seesaw that allows you to bet on what you care about, while someone else can go and make money off of the differential, which is really important. That's never existed in the market until today.
So in this process, the bottom line conclusion itself is very surprising, but were there any other surprises along the way for you?
So surprises in writing this blog? Is that what you're saying, Dean?
Researching it, writing it, kind of digging in, right? I mean, obviously the top line is pretty darn impressively interesting. But as you were doing it, like, was it the order of magnitude of some of these moves? Were there other things that just really kind of shocked you?
Yeah, there were definitely a lot of shocking pieces in this. I mean, look, from 2020 on, right, there were 45 moves of over 3%. That is an incredibly large amount. Okay. Not only that, there were 13 moves of over 5%. Okay, let's focus on that point for a second. Those 13 moves, there were only 8 moves of over 5% from 1990 to 2007. It wasn't necessarily, I knew that there was a problem with mispricing in the market. I was shocked that we were this far this fast. I think the magnitude kind of floored me. And Gene, you could even attest to that. I was on the train going to a meeting, and I called you, and I was like, I just had to tell someone about this, because it's just this shocking, like this. And then right after that, Misha, who is online right now, I said, Misha, I got to tell you about this because I think I'm wrong, but I'm not wrong. I ran the numbers, and Misha looked at it, and he was like, yeah, I mean, I don't think you're wrong. It's just pretty messed up. So, Misha, I don't want to talk for you, but yeah.
Let's put him on the spot. Misha, what did you think?
No, I mean, look, it's not particularly surprising. I mean, for the reasons that you guys have already discussed. Sorry, I should say not because the magnitude of it is surprising. The directionality has been going this way for a long, long time. Price discovery in markets is expensive, right? You need, teams of analysts to go out and understand what these underlying companies are doing, and index investing is really cheap. You just look at the market cap and you divide that by the market cap of the entire index, and that's your weight, and then you just buy that many stocks, right? And so, when you have this kind of transition, it's problematic. And I think what we're kind of skirting around here is, in theory, right, there isn't an equilibrium here, right? In theory, what should happen is as more and more index investors come in, right, investors who do price discovery should have bigger and bigger gains to be made. I mean, let's take the world where literally everyone is an index investor, right? That implies that anything that's not in the index basically is priced at zero. Well, I can get a lot of free stocks that way that clearly will have some value, and eventually somehow I will understand that value. And what, but the problem is there needs to be enough other residual people that price discovery is eventually rewarded. And this is, I think, what Trent hasn't. I want to just reemphasize this, right? Is that this is kind of what the presence of a DC allows you to do. If we're at this kind of tipping point where there is not even enough price discovery such that if I buy a stock that is badly mispriced, I have faith that enough other people will look at it to eventually adjust the mispricing so I'm rewarded. I'm just out of luck, right? But the presence of something like a DC essentially solves that problem, right? Because now I have the ability to say, you know what? I don't even know if this thing is ever going to re-rate, but at least I can get the cash flow that this thing is ultimately throwing off, and I don't have to sort of pay a very badly mispriced price for that cash flow. I can just kind of say, look, what's the approximate risk of that cash flow? Okay, I'm going to get that. And so I think that to me, that is what the big game changer is, if that makes sense to everybody.
Yeah, if I could expand on that, and Misha, I think that's a great point. It sets a new floor valuation, and in a world where there's 20% ownership of an individual stock, if at one point in time, and I kind of quote this, if there's some mass unemployment event where people take their money out of ETFs, and let's just say half of the money leaves, that's 5.5 trillion out of the market. No liquidity provider, no market maker, no anyone is prepared to absorb that loss. It just won't happen. You'll see gap downs. You will see a lot of these companies down 70, 80, 90%, which then brings up a very interesting question. When you have companies that are no different today than they were yesterday, the only difference is there's mass unemployment today and there's a stock market crash. The DC provides an ability to say, well, there's still this inherent value to this company that is creating an incredible amount of cash flow. And that has inherent value to the market, which, as we have started to fundamentally push active investors out of their seats, we're in a much better position today with the Permuto product to stabilize those valuations at levels where it is reasonable. Would you agree with that, Misha?
I think so.
That's the professor. That's the professor in Misha right there for everybody else.
Professor boy.
Yep.
So just to head off a question I know we'll get, how are we doing on this project? Are we kind of on schedule given a week or two? Where are we at?
I'm happy.
That is a good answer.
I'm happy. I'm happy with where we are. I think I'm excited about what's to come, but I'm happy with where we are. And yeah, look, I don't think there's much more to say right now, right? Like we are working hand in hand with the SEC, and we are working hand in hand with partners to make sure that this works really well for investors when it comes out. But that is the most important thing, period.
Absolutely. Yep. So there is a question that came out of the Permuto Discord channel, and it was, what's the impact of, this the negative effect on late stage venture companies and venture funds and PE?
Oh God, that unveils a whole can of worms. Look, there's a lot of assets. Oh God, we're going to do like a macroeconomic, like freaking class. There's a bunch of assets that private equity firms own today. Those assets may be too large for any other private equity firm to purchase. Think the Blackstones, the Thoma Bravos, the very, very large companies who are the very smartest in the world at what they do. They might own assets that are simply too large for them to offload to anybody other than re-IPO them. So the problem is they're now faced with a question. Do we IPO into a market where the only thing that matters is whether or not we're in an ETF or whether or not we're in the S&P 500 or the NASDAQ 100. Is that what is most important? Or do we believe that we will get our current value because active investing is back? As of this moment in time, from really the end of COVID, so let's say 22, after the SPAC craze, to today, there has not been meaningful IPO activity that has been priced well. That is scary for private equity firms who need to enter the markets. The IPOs we've seen are up 100% or multiples of 100% or down 30%. And private equity firms are not able to withstand that and maintain their IRRs. So, I mean, broadly speaking, private markets are not separate from public markets. Private markets need to eventually become public markets. They need to pass on companies who have become mature or who are maturing into the public sphere so that people can profit off of them, so that people can get dividends. In general, the IPO market is suffering because companies are choosing to stay private, given the inefficiency in these markets and the fact that hedge funds are not valuing them for what they are worth. And instead, their entire valuations are driven by the fact that equity flows define their largest component of investment. And so the largest private equity firms get it, but they also understand they need to play the game and they need to get some things off of their books. And so I believe it's starting, but I don't think you're going to see them offload a large position at a very de minimis price. I don't think that's going to happen. And until we start seeing investments that are actual investments rather than just playing a pop, I don't think we're going to see that. And I think we are fundamental to driving more value back into the fundamental analysis to allow for IPOs to start happening again and the private to public shift occur once again.
And I want to hop in here just because I know this will probably generate some questions about the Chia Network IPO. We certainly are affected by these macro issues, but we're also not trying to price to perfection. But differently, we're willing to put up with a little bit of a pop. But that said, we're a little bit different than what we're coming out of private equity or what I'd call a traditional venture capital backed late stage company. So let's see, do we have any questions from the audience? Will we be able to offer non-dividend companies in the ACDC wrappers? And how does that work and how do we think about that? And Trent, you're muted. I have a feeling Trent's doing a monologue to himself.
Hey, so, okay. Sorry about that. So non-dividend companies, ACDC wrapper, it's really interesting. I would love to create it, mostly because, and this is where I actually want to lean on our glorious CFO, Misha, but from the perspective of, if I look at Amazon has a massive capacity to pay a dividend. However, they don't. They return their capital in numerous different ways. If we gave a reason to pay a dividend, maybe to provide a floor value for these new active investors, it could unlock an entire new market and new investor base for all of these companies who currently don't pay a dividend but could. But Misha, how do you feel if you had a company like Amazon?
Right.
How would you think about that from your from your old perspective as an equity research analyst?
Yeah. No, sure. So there's a two-pronged analysis that is there, and that is the ability and the willingness to pay dividends, right? And so a DC on Amazon today would have some value, all right? Because remember, it is a perpetual instrument, and so the value of that instrument is not just the dividends today, which of course is zero, but ultimately the future value discounted back to today of all future dividends, and ultimately at some point you would expect, even a company like Amazon with an enormous array of opportunities and places to spend that capital in front of it to eventually begin to return capital directly to investors in the form of a dividend. So it's just kind of a question of when and how. And then the second element, of course, is the actual policy decision. What is Jeff? My apologies. My guard dog is defending my home here. And so the second question is then what happens, with regards to the actual policy and how much of a priority is that placed on? I mean, there's no doubt that they could pay dividends today if they wanted to. And so, as an investor, I would have to, analyze and get comfortable with those two things. And I think the existence of a DC as this market begins to develop is ultimately going to force corporates to, think both about their communication on dividends and how they're going to run dividend policy. And I think it creates a lot of interesting questions for companies, such as how will they apportion cash return value between things like ACs and DCs when they're deciding if they do have excess capital, do I pay it out as a dividend or do I repurchase shares? And, obviously as a dividend, it goes to the DC. If I repurchase shares, that value will ultimately accrue to the AC. And so it will sort of create, kind of interesting questions for corporates and for CFOs.
Yeah, and I would only add that, we are not ruling out being able to do those companies that we think are, especially soon candidates for dividends. We just wanted to get some experience with the first process on how our create redeem fees will look like for trust to make sure that we're having comfort that we've got, a real ability to break even a profit so that we don't have a trust that's sucking money as we operate it. So we're excited about that opportunity. There are a bunch of additional stocks that are not in our kind of first 86 that would be very exciting to do that with. Let's see, turning to questions. I think we handled that. Trent, you mentioned this when we were talking in depth about one of the points earlier, but I think we have a question that really hones in on, okay, so if the ACs and DCs get bundled up into ETFs, doesn't it just get us back to the same funds flow problem?
So specifically, when you have an ETF currently, it blindly throws money into whatever is the largest, right? So let's say 8% Apple, 7% Microsoft, et cetera, all the way down. That's not exactly right to any current ETF that exists in the world today. But the concept is clear. It throws money into a specific AC/DC round lot level. It says this valuation is currently correct, right? That's what it says. What if you went and bought 100% DCs? Technically speaking, you're actually fighting against the market. You're not buying the underlying stock itself. You're buying a very specific position. If you buy 100% of the AC, you're also buying a very specific position. And what that means in my mind is that when you're not buying the position of the market, if you go and purchase a grouping of ACs, right, then you're going to firmly increase the value of the ACs. What that does fundamentally is it increases the yield of the DC of all of those same components. And so if there is not an equal or opposite reaction in the investment of those DCs, then you might go and see that Microsoft is trading for a bond equivalent yield of 11%, which makes very little sense. What we're doing is, if either side of this ETF becomes extraordinarily popular, what we're doing is making it so that it's very obvious to the investors that there is a mispricing going on, and allowing them a way to fix that mispricing without having to short the actual stock that exists, which is not an efficient way of doing it. Because you might believe that Microsoft is a good company. You might just also believe that the multiple that is being placed on their operational growth is way too high. And so by us offering you a way to do one or the other, or both, we're offering you the ability to stabilize a stock based on its merits. And that, I think, is very important. We're not just saying put money in and you buy it at whatever price. We're saying put money in and you receive this yield. Well, if way too many people put their money into a DC ETF, then that's going to be a problem for the yield of the DC ETF. Flowing capital based on market cap, right, is not efficient, but flowing capital based on the actual metrics of an individual company, based on the metrics you care about, is very powerful. It's very important. It allows you or investors to right a market that has gone wrong, right? So, for example, for the last 3 years, it's highly likely that someone would have heavily indexed towards the AC of NVIDIA. Well, today, the DC of NVIDIA would be trading at a massive premium because the AC went out of control. That allows the DC seesaw. I like to say, I mean, it's
I mean, oh my God, you taught the boys how to ball.
Then the DC yield goes up. When the DC yield goes down, the AC natural leverage goes up. And so there is a natural tipping point. There's a natural balancing point for every individual stock that is fundamentally different from one another. And that is a very important piece of information, that even if there are ETFs of 100% DC or 100% AC, for the vast majority of investors, 100% DC or 100% AC of the market is not the proper way to hold their stock portfolio. For instance, if you're 38 years old, it's probably some mixture of ACs and DCs. You probably need some element of growth and some element of income. And that is where this comes. You don't just have one option, buy or don't buy the stock. You now have buy the stock and in what exposure ratio, which is very important.
Great. So this is kind of a question, I think, for all of us, but the question was, hey, look, if a new company wanted to IPO and do this themselves without trust, could they do that? And also, the similar question, can an existing company, do this separation without trust?
Sorry, repeat that. I didn't fully get the question.
Yeah, it was if a new company wanted to try to mimic what we're doing by splitting a dividend from the asset component of their own stock, could they do that themselves? And relatedly, could an existing company do this themselves without using the trust structure? And I can answer it if you want me to.
No, I mean, there are a lot of accounting and legal and incentive reasons why the investor bases will not want that. Accounting and legal are not based on the investor base. I don't believe a audit firm would provide a PCAOB audit on that. They also have to define the legal differentiation and value of their individual stock components, which is hard, if not impossible. But also incentive wise for investors, I will put it out to the group here. Would you want a company to issue you, instead of saying we'll pay you dividends on the stock, we'll issue a stock and we'll issue a dividend? That dividend, we could cut it at any time. Who would buy that if it has no impact on the stock, right? So the incentive structure without a third party intermediary is very skewed, is what I would say.
Yeah, and then also there's two things going on here. On the accounting point you made, it's really hard to figure out how you would account for profit and loss to two different assets. So that's what really makes that hard. But on the market structure issue, I think people are sometimes making a conflation when we're talking about these different companies. So there's a really big difference between a small cap company going public and a large cap company who's got a 10-year history of paying a dividend. And these are company growth and how big they can get and all these sorts of questions. So, and like, that's why when you're talking about some of these assets that private equity can't easily IPO, those are mid cap to large cap assets where, like, even on a outlandishly good day, the Chia IPO would probably be considered a small cap to a mid cap at best. And, you expect companies to kind of go through this growth cycle. It's, you go through and you're venture backed and maybe you're private backed and then you go public and there's a baby public company and you're going to pay a dividend until you really grow like mad, and growth starts to slow a little, but you got to expand that business. Then you start looking at this and going, hey, I might pay a dividend. Now I will say that I fully believe, and I think you'd agree with me, when you should, that this product is going to cause that mid cap company to look more closely at potentially paying a dividend. And maybe doing that sooner. I think it may bring it more back into vogue. It's been somewhat out of vogue, if you will. But I think there's a lot to be said about where these companies are stage-wise. And that actually leads me to another question, which I think is related. And I think you'll know why I say it's related. Celeste Heimler asks, isn't such a basket product still dependent on what Permuto decides to create a trust for? And isn't that therefore kind of based on market cap? So it's not all a problem.
Is this in Discord? Because I kind of want to read it.
It is. It's a second last in Discord. So we'll do a second.
Isn't such a basket product still dependent on what Permuto decides to create a trust for? Which itself is a decision at least partially based on market cap. I would say it's less based on market cap and more based on their ability to pay a consistent and growing dividend. So yes, we have market cap delimiters where we deem that this is a large cap product currently. But that's not. So yes, the basket depends on that. But as of right now, if you looked at the Magnificent Seven, it probably makes up over 40% of any basket anyway. And the Fortune 100 probably makes up over 90%. So I don't think we're going to cut it down based on our decision of what we're bringing out. And I also think they're with, 86 or 87 of these things. I don't think that it's delimiting that number that much, right? I don't think we're reducing that figure. And to the extent that we can work with a company and we can eliminate custody fees and we can do things like that, and we can utilize their TA rather than our own TA, things along those routes. There are ways to make it, instead of Fortune 100, Fortune 250. I'm not saying we can get all the way down to Fortune 500, but we can get close. We're limiting the size of the market cap currently as well.
Now here you go.
growing dividend stream into the future, is what I would say.
Right. So I had another question I'm going to take the answer to. The question was, hey, so, can these security assets, chia asset tokens of dividends and ACs, can they be bridged to other chains? There are a couple different answers to that question. One of the most immediate answers is that revocable cats aren't usable with the current warp queen bridge. So the primary way you would do that, can't do that. The more interesting answer is that to do that right, you probably need an ATS license. So it is quite possible if you're an SEC license, and it might be a type of a broker dealer, we have to dig into that a little detail, but you could, for example, be a trusted single party because you are licensed with the SEC and, effectively custody a cat on behalf of an investor who's got it trading on another chain. So there are pathways. The, semi decentralized stuff is where it gets ugly because usually the lines are drawn with custody. And, custodying a security almost always means you need a securities license of some sort. So more on that later. We even ourselves talking about it internally and at the SEC. The other question we had, I think I misplaced the other question. Jim Rack Crypto wanted to step up. Do you have a question, sir? And you are muted. I'm going to take that as a no, or that he'll get to me in a second. It is about an hour in, so we'll take a question or two and then wrap up. Unfortunately, the work day for Trent and I is not at all done. Luckily, that does include some more steak.
Honk.
You've corrupted him.
It seems like we've done such an amazing job that no one wants to come and ask a question. Honestly, I'm flabbergasted.
They're just afraid of Misha.
It's quite an amazing situation. I've never seen a crypto crowd at a loss for words. It's amazing.
Well, we only told people the entire stock market doesn't work and proved it. It's a small thing.
Yeah, that's fair. Okay.
Hey, everybody.
I'm
Brevity
not
is
I'm not gonna lie.
Yeah,
I'm
go
a
ahead.
little surprised Tangang hasn't come up here and asked a bunch of questions. It's pretty shocking to me.
Well, they're all in here.
I know. I see them. Shout out Tangang.
We see you. Keep those oranges flowing. Okay, we got some questions. Let me bring some books up. Go ahead, guys.
Hey guys, I wanted to ask, when you guys were talking about a POP earlier, I'm familiar with the acronym, but could you talk a little bit more about what you were talking about there?
I got to be careful here, but
You're the banker. I'm the business guy. I can actually answer this question better than you
okay,
can.
you answer the question. I don't want to answer it.
You don't want to
Thanks,
answer the question.
Thanks.
Yeah, absolutely.
If it's too hard, you guys can tell me.
It's not that it's hard.
No,
it's that
it's
I
industry.
value my career.
Right.
Correct.
It doesn't
Right. Yeah.
necessarily lead into honesty in some cases.
Right. But as the buyer of going public services in the past and in the future, generally a IPO is considered pretty well priced when it trades up something like 20 to 40% on its opening day. And there are people in Silicon Valley who hate this and say, you should only do direct listing. There should be no pop at all. The company should get exactly the right value for their shares on day one that they want. I can tell you as the CEO of high growth companies, I'm kind of okay with my early institutions who are willing to bet on our firm getting a nice little cherry on the top that makes their risk take a little less risk and means that they kind of won't be bothering, for example, Nisha and I for the first year or two because they're generally up, and so they're not going to complain too much. It's a positive, and so a well-priced one has a little bit of a positive because what you don't want is a broken IPO. Broken IPO trades down 20% on the first day. Like that is bad everywhere. So, as an entrepreneur, as the company going public, as a smaller cap company, you're willing to trade off a little bit of discount to make sure that you've got a positive IPO. Now, unfortunately, the press is kind of dumb on this topic. And so they get really excited when it pops like 100%. And so like Circle pops 120 on the first day. That is a Charlie Fox drive. Like if I were them, I would want the head of equity capital markets somewhere. Because they basically left $1 billion on the table on day one. Now that it ran further, it gets a little less annoying because it's like, yeah, you wouldn't necessarily captured all of that value. And you do want it to run. I mean, you as the company and as the banks group want to see the appreciation of the first few days and the market, accepting it. But we've seen bad ones like this before. Facebook was mispriced pretty badly as well. Google had it a little bit, though I think the street was trying to punish them for trying to do a Dutch auction, which is again trying to stop the pop. But look, I'm a little old school on the pop as a public company in the past, and like again here in the future, I'm okay with a little bit of a first day pop, but I am not okay with kind of a 100% pop. Now, what Trent was kind of getting at is that right now, a lot of what I would call sophisticated financial institutions aren't really willing to invest. They're not really making that decision like an ARC is in Circle situation. And so they're like, look, I don't want to look at it. It's not going to pop 40%. And that starts to get expensive on the other side of the table. It's like, wait, you're basically saying I have to sell you this at a 40% discount because you put money in on day one? Like, what? So that's part of the problem. And then when we get these really highly valued things where everybody kind of agrees because this thing is blowing off $1 billion back, it's worth $5 or $6 billion easy. You can't really easily discount that. Like you still look at yourself as investors and go, "There's no way I'm selling it that cheap." So that's where you see a lot of the late stage high growth or late stage high cash assets not on public. Did that answer the question?
Yeah, that was awesome. I had a feeling that's what because I think you mentioned it, Gene, and Trent mentioned it, and I took note and just figured a little extra clarification because it's just it's one syllable, easy to miss. But that's what I thought you were talking about. I appreciate the expansion. Thanks.
Yeah, you bet. Waffle.
Hey, Gene, pleasure to be here. One question, it's a bit of a two-parter. Do y'all feel like things are progressing in the way that y'all had foreseen, as far as, kind of the give and take of dealing with the SEC? And also, can I get a honk? That's about it for me.
I already honked.
You
I
got
did
a
it
honk
already.
from Trent.
I
Oh, but
honked
I just
before you
really was
came up.
hoping I could get like a three-way, three co-host, all like a general. But it's fine. We'll
As
take
a
what we can get
rule,
and
I
then move
don't
forward.
do three ways. As a rule.
I see. As soon as I get on stage, things take a turn for the way
Worse.
different. I
You
got
asked for a three-way honk. I don't know what you were, what else you were
Foods knows what I
hoping
mean.
for.
Okay, all right. We're just gonna kill it there. We're
Foods.
getting to
Yeah. So
Okay,
look.
no,
Okay, good.
But what I will tell you is I'm very happy with where we are. There's still more to get through with the SEC. It is in our mind, we need to be partners with the SEC and not be antagonistic in any way. However, I, at this point in time, do not see the regulatory angle as the long pole in the tent. I believe that we have a good rapport and we have a good conversation going with the SEC currently. And I think both sides realizes the effect of the product and wants to ensure a positive rollout for all market participants. So I'm pleasantly surprised by the sophistication at the SEC currently, and I'm highly encouraged by that fact. And look, what we're looking forward to right now is designing the launch strategy to make sure that these products get into the hands of those who want them as early as possible. So that's where we currently are in the process.
Yeah, and I would say it this way, I would say I am probably wishing we were about 2 weeks a little further ahead, but that's about it. I will say I've actually been surprised about how quickly the SEC has moved and how there's work, but it's light touch. It's hard to explain to people. Like people are used to the Bitcoin ETF, which was not this. This is something where they're like, this is cool, and we'd like to see this work. You know, they certainly have questions. They want us to clarify things. You know, there's work to do, but they are, as Trent said, not the long pole. The other thing I'd say that was surprising is our reception has been even better than we thought it would be. It is kind of frightening how much that reception is positive. It's also been really surprising. We don't bring up the blockchain a lot on Wall Street. They do. And I think it was in like of 8 or 10 meetings we had, all but 2 of them brought it up. Really fascinating. I guess it's that top of mind. So, you know, I think the other big surprise is as we get into the nitty gritty of getting these things live, I think we're finding that we are having even better partners. So we're welcome to those partners. And there are some additional opportunities in how we bring some of the initial pack together, not necessarily for 6, but the ones after that, that are going to be even more profitable for multiple parties around the table. And that just makes this become even easier for everybody to sit there going, you know, we can bring all the constituents together at the right place, at the right time for the party, and the party will rock.
Yeah, that definitely satisfied my question. Okay, thanks. Appreciate it.
You bet.
I got another question, but I'll get in line. I think Jim Rat and David maybe had their hands up.
Yeah, Jim Rat would have been up first and couldn't get off mute, so let him go. Oh yeah. Well, I think one of the things we want to do is over the next year after we launch these is really start educating people about how you can use them. I mean, it's really, you know, today we kind of gave you that example. It was kind of clouded, but it's a specific company and a specific outcome. And I think we'll probably even end up in some of our S1s and stuff. And so I think it's really like letting people think about exactly how it'd be relevant to you. And so, like, let me say it this way. We were talking to a Canadian fund, and without us saying it, they kind of popped up and went, "Hey, wait, we invest everything out of Green Cayman, so all the stocks that we hold long, we should hand them to you. Sell the DCs off, buy more of the ACs because we don't like dealing with the IRS and taxes, and that's going to accelerate our returns on our investments that we already believe in long." And so,
Well, can I just put like real numbers for maybe regular people?
go.
If you invest currently, if you just bought, say, Microsoft, right, in the regular in your regular account, and then you also invested in Microsoft in your retirement account, you would get about a 1 to 1.3% benefit. If you instead said, I want to buy the AC in my non-retirement account, which by the way is tax-free until you sell it, right? And long-term capital gains 20%. And then I also want to put the DC into my retirement account, call it a Roth, call it an IRA, whatever you want to call it, then you would receive a 6.2% tax benefit for every single dollar. Now, the average return of the S&P 500 over the last, I don't know, 100 years basically, is 8%. So your tax benefit is going to profit you 6 extra percent, i.e., instead of 8%, 14%, instead of 1%, 7%. You will return, due to tax savings, almost more than the average return yearly of the S&P 500. So that's the way this is different. By us putting this in the traditional system, which is very important here, you get to abide by the traditional system's tax laws, which is very beneficial for you and for everybody. This is into your current retirement. Go ahead. Well, so I'll make it very simple for you. Right? It's very, very simple. If you place DCs into your retirement account and you put ACs into your regular account, you will never pay more than about 22 to 23%. The reason I say 22 to 23% is because we will not always have 100% capital gains deferral, but you will never pay more than 22 or 23% taxes on the income that you make, period. So, look, I'm co-CEO of Permuto. Gene is fucking CEO of Chia, right? Gene is going to have a different opinion as me. We are going, as you can see with this blog series, I take a little bit of time between my blogs. I research my blogs. I make sure that you have all of the data and you don't have to trust that the data that I am bringing in is from very trusted resources. What I'm trying to give you actually as a content creator are tools to create content, right? Like create the content of, if you're a 25-year-old person, you should be investing in ACs. If you're a 80-year-old person, you should probably be investing in DCs, right? Create the content of what actually makes sense. If you, content creator, were investing, how would you look at it, right? How would you break it down? And look, the other thing I will say is you don't have to do it alone, right? Content creators, if you have questions, if you have comments, if you want to do a podcast, if you want to do stuff like that, Gene and I are available. You got to reach out to us. You got to go through the proper channels. But if you want us to help create, content, we're here. And we're here to be on podcasts for you to ask us questions. This isn't good. Yeah, that's fine. That's fine. Like, we are here for the investment. Yeah, go ahead. Awesome.
Thank you.
Well, appreciate it, and we're always here to answer your questions. So shoot us an email. I think it's info at permuto.capital. And we're here. We're here to help.
Yep. And also DM's obviously also available. We're
DMs,
pretty easy to find.
work too. Yeah.
Yep. Yeah. Before we grab on anybody else, there was one question like, how many are you going out with? We believe we're going out with 6 initially. We have not filed all of them yet. They are quick to file now because we kind of only are working in Microsoft on the SEC. But I will tell you that, our partners are going to have a lot to do with this. And there are a couple different partners who may influence us one way or the other, all in good ways. But, when a large Wall Street investment bank speaks and has an opinion, you listen. But also note that those partners are speaking to us because they see the dollar signs too. Okay, let's take one more question. And I think we probably do need to wrap.
Honk.
There it is. Yeah, this is a bit of a two-parter. Well, one's just a general
shot.
chia question, and the other one is more of a just personal, I guess, kind of view of the market. And I've been thinking about this myself a lot lately. Do y'all get frustrated when you see things that have not gone the links that y'all have gone through to make the product you have made and make it in the way and align it in the way that you know can facilitate these products? And again, we're not going to get into specifics. We won't throw any shade, but when you see these other entities implying they're going to do similar things, does that frustrate you, or is it kind of roll off the goose's back? And then the second question is, when can I get my ACH to XCH? But I'll let y'all.
So thing number one, what you just described is Wall Street, and generally speaking, Wall Street people who try to cut corners don't last on Wall Street long. So there's a proper way of doing things. The cream rises to the top pretty much always, and just remember we're running a marathon, not a sprint. So I'm the only that's number one is the only thing I can talk about. Gene, you're on number two.
Yeah, though I will say on number one, charlatans everywhere. Anyway, so on number two, we were originally saying that you would probably see ACH sometime by like into this week, sometime in next week. I will say it's about a 2-week slip. It does not mean Cloud Wallet is slipped. It just means the ACH piece slipped a little bit. So certainly still just either just within the month or just after the start of next month. So it's that sort of time frame right now.
Thanks, fellas. That's all I got. Appreciate your time. Keep kicking
Pleasure.
ass, man.
Okay, folks, we're going to end it here. I want to make sure that recording's not too darn long for everybody else who couldn't make it. We will do this again soon. We'll caveat one thing that if you guys have not inferred, Trent and I are burning the candle at both ends on both coasts, or at least for me. So we have to sneak these in when we can. So thanks, everybody. Thanks for all the support, and we'll keep kicking ass. Have a good one, everybody.
Thanks, everybody.
You say you want your freedom. Well, whoever I keep you down. It's only right that you should play the way you feel. You go.